Hello, everybody. Welcome to Friday, another Talk Money with Tom show. We are trying to help you answer questions. You can send them in now. Send them to our email address at AskTom with talkmoneywithtom.com. You can put them into the chat box. We love to answer questions about retirement planning, how to manage your money, tax planning, those types of things. You know, we believe that education is an important component of having a successful financial retirement. That's why we created this channel. It's why we do this show. You can subscribe to this channel if you go to hit the subscribe button, hit the little bell if you want to get notified when we, put new content on. And then, of course, maybe you have a personal question that you want to ask and maybe not ask on the show. You can go to our website and go to the book appointment button up at the top, and you can go ahead and set up a 30-minute time to meet with Eason and I to answer your questions on a one-on-one basis. So really looking forward to today's show. Hope we can help you with some things. We have some good questions that already came in. You can send in questions at any time. And then we obviously get questions within our clientele that we'd like to share also. So good day today. Hopefully we can help you out quite a bit. I do like to start off the week every time with a summary of what I saw happening for the market this week. And here's a chart of the S&P 500. Year to date, you can see, that red line is kind of showing across the tops there. We're still in a down market. The blue line is the 200-day moving average. And what we've had, though, is a really good run up from, right where I'm sitting here, basically the bottom of October to now. And we even got through the 200-day moving average last week. Chairman Powell was talking at the Brookings Institute. The market thought that what he was saying sounded good, apparently, and the market moved up quite strongly based on that. So we have taken that back now as far as that goes. But there's some really important things happening right now that are quite different than they were even just a few weeks ago. And so one of the things I'll share with you here is just, this is the SPDR S&P 500 ETF, SPY. I'm just showing the part of the run-up here that we've had since the middle of October. And I'm using a line chart here because the line shows closing prices. And so I've drawn a nice little blue trend line there. So you can see we're holding this trend line so far. We're continuing to kind of march up, and we jumped through the 200-day moving average, but we didn't quite get through that red, trending down line. If I change this chart, same time frame, to candlestick chart, you can kind of see more of what was going on because candlesticks show the intraday activity also. And so you see that big green piece where we hit the bottom back in the middle of October, right? I mean, that was a huge turnaround day, and we've catapulted off of that all the way through. And then if you look most recently, the last 3 or 4 days here, we've been kind of bouncing off of this trend line, so we're kind of challenging it. But if you look, last week, we got all the way up to that red trend line that we've been trying to break through. So in classic, technical analysis terms, a downward trend is a series of lower highs, right? So that's what that red line is showing. And there are several different things that you can say that would happen to create that trend in the other direction. So our primary trend right now is down. How do we get to a primary uptrend? Number one, get through the 200-day moving average, which we did for a couple days, and then it came back. Number two, get through that red line, break the trend, stay above that. And then the last one really is just setting up a new high that isn't lower than the previous lows, previous highs. So what's fascinating, though, here is if you look, that red line, there's going to be a lot of selling there. That's why we got there that one day, right, and sold. Because there's a lot of technical analysis programs and people and managers that have short selling, orders in at that red line or someplace close to it. So there's selling there. Now look at the blue line. The blue line on the bottom is showing, higher lows. That's a temporary, at least at the moment, uptrend. And so there's buying on the blue line. But if you notice what's happening now, they're converging. And so something's going to happen here.
So, yeah, this is a pretty classic triangle pattern.
Yeah.
And so either you break up or you break to the downside. And so that's usually, once you have this break, it's a pretty dramatic one.
Exactly. And so, which way will it be, right? I mean, there's a couple things here. Number one is we are kind of bouncing off the lower one. We're eating up some of that buying on the blue line. So that's a little concerning. Rather be closer to the red line. But It's also not moving that much in the last 3 days. Next week is very significant because on Tuesday we get the CPI report, and so we'll see what inflation was. If you remember last month, it was a huge surprise. Market jumped way up, and because it went to 7.75%. The Cleveland Fed does a projection for the CPI each month. Right now they have it at 7.49, which would be a nice drop from 7.75. Still very high, but really at this point we're just hoping for direction, right? Continue to see it coming down. And so we'll see. Maybe the market jumps again and gets through that red line based on a better CPI report. Maybe it's the opposite and it falls through that blue line. So we're all kind of in a waiting mode right now, and you can see what's going on and kind of how this thing is being pinched.
Yeah, the market's looking for kind of that confirmation.
Yeah.
Is it a confirmation that we're in a good trend, we're going downward, we have 2 months in a row that inflation's going down,
Yep.
or was it just kind of a false positive?
Yeah, I mean, we break through that red line with some power for some whatever that reason might be. We could be on our way to a new positive trend here that could hold up for a while. It'll be nice to hit another new, get above the high that we had in August, for example, those types of things. But we break below that blue line, we could go back down and set up a new low below where we were in October. So right now we have 75% of our allocation, our normal allocation to stocks in the market, in the S&P 500 and the total stock market index, specifically our two bigger holdings. But what we're looking at there, and the reason we're not 100% is because of this pinch. It depends on which way this goes. If it breaks down, we probably should get some more conservative and pull some of that off the table, just because it could really go down quite a bit. If it breaks up, we'll probably get back to 100% of our allocation. That type of thing. So we're right there. We're right at this little crux spot as far as that goes. There was a report today on inflation. This is the Producer's Price Index. And it was a little bit higher than expected. And so the market actually dropped a little bit on this because the market is moving on expectations, and when those expectations aren't met, it readjusts one way or another. However, if you look at the actual trend for the Producer Price Index, it was 11.7% back in March, and now it's 7.4%. 7.4 is still too high, but the trend at least is what we want to see there as far as that goes. So I really think that, one of the things we've got to keep focusing on here is what's happening with inflation, especially here for the short term until we get these reports, until we hear from the Fed next week. But I do think there'll be some shifting going on. And here's another inflationary number that just came out yesterday. So last Friday, the federal government put out the jobs report, and it showed hotter job market than thought. Right, 263,000 jobs instead of 200,000 jobs created, and the wage growth was really twice as much as expected, and that's why we've come down from kind of challenging that red line. But this one is very fascinating. This just came out yesterday, so it's in Bloomberg. This is Indeed, which is the company where you can list jobs if you're looking for employees, and they put out a report showing the annual wage growth year over year. On the job listing. So their point was our report is maybe showing the future because these are jobs that are being listed now. The government is reporting what people are actually getting paid, which might be a little bit of a lagging indicator. So this would be interesting. What they did say about this report was that we would get back down, if we follow this trend the way it's going now, we would get that back down into that 3-4% annual increase in wages by the second half of next year, which is where we were before the pandemic started. So this is a big deal because a big part of inflation really comes from wages.
Yeah, would there be any difference in the job postings versus the Fed's report? Because Indeed only probably posts a certain amount of jobs. Would there be any kind of difference in data?
Well, they're both probably a sampling, right? I mean, the Fed isn't every job. Either. In that job report, it's a sampling survey based report. This has, I've forgotten how many jobs they analyzed for this, and they broke it down into categories. So I mean, they both have probably their downfalls, as far as that goes. But I still think it's very fascinating. Just this gut feel that that inflation is getting better and better, and the market. And one of the things you can see here too, this is the yield on the 2-year Treasury, right? So what the 2-year Treasury will pay, and it's going back. And I've drawn these two parallel blue lines there. That was the big rally we had in the summer, middle of June, July, ended up ending middle of August, about an 18% run. You can see the yield went sideways, but it was moving upward right at the top, and eventually it broke out of that range, and the market collapsed, and we went all the way back down to a new low in the middle of October. So then we got this other channel up here on top where we've been moving since now the middle of October, kind of coming up. And you can see there, we're definitely softer in that channel right now. And, maybe the overall trend line right there, that we call that a descending triangle, actually. So that could break up or down. We'll have to wait and see what happens. But when you see the 2-year Treasury yield coming down, that likely means that the Federal Reserve, at least from the bond market's perspective, will be slowing rate hikes or stopping rate hikes or even eventually, lowering rates as far as that goes. And the bond market is really, really good at predicting where the Federal Reserve is going to end up going, more so than they are. The bond market has been more accurate at figuring out where the Fed is going to go than the Fed has been figuring out where they're going to go. So anyway, so this is why we watch this so closely. This is a good sign, right? However, one of the reasons that the yield can drop is because of a recession.
Yeah, because if people are worried about the market, Fed is going. If something breaks in the market, Fed has to step in and lower rates.
That's exactly right. So if you start to see unemployment jumping dramatically, that's one of the Fed's other criteria is to try to keep full employment. Maybe they start to lower rates, and and there's things that are going on probably in the economy that aren't helping earnings at that point in time. And so my key point here now, in my opinion, is the market has been obsessed with inflation, right? And rightfully so. But I think because we're starting to see inflation kind of peak, and hopefully it keeps coming down, and because we're seeing the direction of inflation, I think inflation as a driver for the stock market is less than it was. I think the main driver now, and the thing to really focus on, is recession, right? Because that's the big thing. We've seen all of these flashing red light signals saying recession next year. I mean, there's just so many. The inverted yield curve, the leading economic indicators, et cetera, et cetera. There's a fairly good chance we have a recession, but how bad will that be? And more importantly, how much does that impact earnings, right? And so this is a pretty cool chart that shows in all the recessions since 1957, what happened to the S&P 500 during the recession. So once the recession is called to when it ends, what was the rate of return? So it might have dropped or gained before, or what have you, but just right in the recession themselves. So if we're worried about a recession, what happened in the past is something useful. The average return is actually negative 1.5%. So that's pretty interesting. And there's a whole bunch here where it actually went up. However, if we look at kind of the time frames that are more like what we have now, nothing's exactly like what we have now because none of these include a pandemic.
Yeah.
But 1973, it was down 18%. 1980 was another high inflationary period. It actually went up 16%. And then in 2000, we had this bubble type mania, sort of like we've had here in 2020, 2021, and it was down 7%. So, it's a little bit of a mixed bag as to where we might be as far as that goes. But honestly, if we drop 7% more from where we are, and that was it during that entire recessionary period that we might have next year,
It's not too bad.
Yeah, that'd be pretty doable, right? I mean, especially because there's a silver lining here. I know there's a lot of numbers here, but what they're showing here, and this is again from Invesco, is the first column shows the rate of return for the S&P 500 in the last 3 months of the recession. And it's 12.9%, which is fantastic, right? 3 months, 12.9%. The 1 year after the recession ends is 15.3% average. 3 years is 40.1%, and 5 years is 78.7%. So this is the key. This is the silver lining. If we can get through this, if we can preserve capital, if we can buy back in at the right times, all the things that you might do, just hold on, whatever it is, whatever your strategy is, once things kind of get through, then things can take off. And here's why. Right now, there's a misallocation of capital that's been going on from 2020 and 2021. The whole cryptocurrency thing, what did it get to, like $3 trillion, right? That's money that should have been going to Apple or, a company that had actual earnings. It's now down to 800 billion. So what we're doing is we're squishing out some of these things, these IPOs, the companies that didn't have a product yet or didn't have earnings, didn't have revenue, and yet they're worth $100 billion or so, crazy numbers like we saw, very much like what we saw in 2000. And the SPACs, remember the SPACs?
Yeah.
Colin Kaepernick was going to have a SPAC, right? I mean, that's too much money floating around looking for things to do. And so that's all now being squished out. And one of the reasons why you see something like the S&P 500 like this doing so well in the recovery from a recession is because people start to get back and focused with the things like the quality companies you'd see on the S&P 500. So this is a necessary environment. You get that expansion, contraction that happens in the economy, and the contraction, theoretically wipes out some of the weak players and some of the players that shouldn't be in there, and capital gets allocated in a more efficient manner. And boy, you can really take advantage of that and gain from what happens afterward. So that's what we're looking forward to. Hopefully next year, could be we've already hit our low in October. Right? Who knows?
Yeah, and you can see in this chart too, it's saying the S&P has a positive return 3 months before the recession's actually declared over.
Yeah.
And so that's showing that the market is forward predicting, and so it predicts positive return prior to the actual recession ending.
Oh, I remember my grandmother saying to me, we're in the middle of a recession and all kinds of people are losing their jobs and the stock market's going up. Why? This is exactly why, because the stock market's looking at the next phase, which is past the recession and past all of the layoffs. Layoffs tend to be lagging indicator, right? It takes a long time to figure out who to lay off. And so, you'll probably find that the bottom, if we have one, is kind of a dark time. It's just nobody's really excited about what's going on. And again, the market is that forward-looking mechanism as far as that goes. And here's a couple of things that I think we should focus on as possible scenarios that help to soften a recession. So if we're going to have a recession next year, and the indicators are saying we should, but how deep it is now the question. Does it really impact earnings? And so number one, this is a chart of the iShares China index. So this is the China stock market essentially. And you can see we've had a huge run up here just recently. And what's happened is that first it was kind of a rumor about the zero COVID, policy starting to soften, and then actually happening. Now there are softening the zero COVID policies, and that's a really big deal. We'll have to see if it works, because if everybody ends up in the hospital and they go back, we'll see how this plays out. But there's two big things here. Number one is reopening China allows the supply chain to get better worldwide, because they're the biggest portion of the supply chain. Number two is they are the second largest economy in the world. They've been underperforming because of zero COVID. And if they start to perform at average, that could be a lot of money being spent.
They're a big consumer of luxury goods for a lot of companies.
Yeah, and now that could also be inflationary, which if they get going really hot, so that could cause some issues too. But in terms of softening a possible recession next year, this is a counter trend to that, right? Yes, the U.S. could end up in recession, but China could start to really boom because they're finally kind of getting out of this scenario that is tough to really have a vibrant economy in when everybody's locked down so tightly. So that's one. Number two, and the last piece here, is the consumer spending. This goes back to 2010. This is in real dollars, so after inflation, so it's still going up, and you can see the dip there that happened in 2020. But still, consumers are still spending and spending and spending. We had, all kinds of different reasons for them to cut back. And this is one of my key points, is that all of the data that we look at in past recessions and how much the stock market dropped and how much earnings dropped did not include a pandemic with a pent-up demand. So if you look, the yellow line is the services. That's your restaurants, your movies, your hotels, your air flights, all those things. That's gone up very significantly, actually. If you look at the goods, the blue line, it didn't dip much in 2020 because that's what we were doing. We were ordering Amazon and ordering,
Everyone's
kitchen
getting their
remodels.
Pelotons. And
Yeah, and now that's starting to drop. See that? So we're probably going to see less inflation in goods and possibly even some deflation in goods for some of the hard goods like big screen TVs or whatever it might be. And we're going to continue to see inflation in the service area. That's a bit of a problem for the Federal Reserve in terms of trying to slow things down, but it also softens a recession. If the pent-up demand continues to go, because, look, at one point in time, nobody could do anything. Even if you wanted to spend money on services, you couldn't because the airlines were closed down, the movie theaters were closed down. And then they opened up. And so the first group that comes out, they weren't afraid of the virus in the first place. But there's still people coming out and coming out and coming out and doing more and more things. And we're just seeing, I think, a continuation of that motion, of that pent-up demand continuing to come out. Now, that is going to cause problems for the Fed. And inflation might rear back up again as an issue, and maybe it doesn't continue down. It has so far, even though the demand is picking up, so we'll see how that plays out. But certainly, this is something where the earnings for these companies could continue to hold in there and not have that huge drop-off like we did in 2008 where earnings came down so much. And I've always liked to say this last piece, the S&P 500, for example, is full of companies that are unbelievably good at managing their earnings, right? And in an environment where there's still people spending, they're going to find a way to manage their costs, keep their revenues, in the right place, and be able to maybe still push through a great earnings per share that people aren't expecting. The last earnings that came out here in the fourth quarter were better than expected, and still lower, right? They've been coming down, but still better than expected, and really kind of was part of the catalyst for the run-up that we've had so far since this middle of October timeframe was earnings. So earnings will be a big deal first quarter of next year. And second quarter for that matter. But anyway, so that's what's going on. That's our kind of summary outlook of what we see happening in the market. We haven't been on in a couple of weeks, so I wanted to spend a little bit more time on it just to kind of emphasize what we're seeing. So look forward to being able to talk to you again next week and show you, what we've got going on. All right, got a question for us?
So our first question, can you explain the exclusion ratio for a non-qualified annuity?
Exclusion ratio for non-qualified annuity. Okay, so we got this question early, so we got a little chart for you. Exclusion ratio. So in this particular case, we're going to, make an assumption you got $100,000. You're going to put it in a lump sum, and you're going to buy what I call a SPIA, or what they call a SPIA, which is a single premium immediate annuity. Right? $100,000. And you can see the monthly benefit is $565, okay? And that benefit is based on your life expectancy and interest rates current, that kind of thing. So what you do to figure this out is really what you're trying to figure out is how much of my $565 is going to be taxable versus how much is just a return of my $100,000. And so what they do is they take your life expectancy, which in this case we'll say is 240 months, and they multiply it times 565, 135,600, right? So that $35,600 was your gain, over that period of time. That's what you're going to pay tax on, at least up front for that 240 months. So 73.7%, which is the calculus, or the math from that division problem. 73.7% of your principal is going to be, of your payment is going to be tax-free. The rest is going to be taxable.
Yeah, the U.S. government doesn't like the concept of double taxing. And so whenever you put in money, it's considered you've already paid taxes on it, and so they don't want to double tax you on that. And so return of capital is always tax-free because you've been taxed on it previously. Another thing with annuities is if you outlive that 240 months, you would start to pay that 100% of that $565 payment would now be considered ordinary income for you and be taxable because you have used up all that return of capital.
Yeah, you got back your 100,000. You lived longer than expected, and now everything you're making is gain over and above.
Yep.
And that means that's taxable, which makes sense. So in this case, you'd have paid taxes on that 35,600, and then if you live longer than 240 months, you'll pay taxes on whatever other amounts that you get out of there, which is fair enough. Now, this is specifically for what they call a non-qualified annuity, which just means that this is after-tax dollars that went in there. This is not money you took out of your IRA or something. That's totally different. But this is after-tax money that you have that you're put into this annuity. And what you're trying to do is generate an income for lifetime, or it's basically buying a pension. I want to make sure that I have $565 coming in, no matter what happens, as long as that insurance company can do it, right?
Yep. And annuities are always considered ordinary income, and so it's taxed at your ordinary income bracket and not capital gains.
Not capital gain. Yep.
So annuities miss out on that nice capital gain tax saving.
Yeah, that's right. All right. What other questions do we have?
So why is the bond market more accurate when predicting recessions?
Okay. So the it really comes down to the stock market and the bond market. Both are actually pretty good. If you look at what's in the leading economic indicator, LEI, from the conference board, it has the S&P 500 in there as one of the 10 pieces, and it has the 3-month, 10-year yield. And so, but when you look at kind of the indicators that have the highest accuracy, they're generally in the bond market. And it's pretty simple to understand. The bond market is very sensitive to interest rate changes. It's one of the biggest drivers. And so economic weakness or strength changes the interest rates that are being charged, what the Federal Reserve might do. And so I have an example here for you. This chart goes all the way back to the 1960s, and 100% of the recessions, and we talked about those earlier, were preceded by the 3-month Treasury paying more than the 10-year Treasury. So that seems kind of wild to a lot of people, right? How could you possibly make more money on a yield basis on the 3-month Treasury than you could on something that you'd have to let somebody have for 10 years? And the reason is because the bond market starts to look forward and sees weakness and sees rates that are lower in the future. And so the 10-year starts to fall. And because we're having some strength or inflation right now, the 3-month is higher. And this particular chart, it basically revolves around zero. So when you see that fall below zero, that means that the 3-month Treasury is paying more than the 10-year. And you can see if you look back, before the 2000 downturn, the 2008 downturn, and now, they're inverted. And so really it has a lot to do with the bond market. Focus is a little bit narrower, as a whole, and especially in the Treasury arena, because we're not worried about, the earnings for the U.S. government. Maybe we should be, but we're not. They print money. They're still able to do it. But what they're worried about is interest rates, and interest rates have a big focus on the economy, and so they tend to be more accurate. I've seen this several times in different places where during this particular, year, matter of fact, the last, say, 12, 18 months, the Federal Reserve has put out these statements of summary of economic projection. They're going to put out another one on Wednesday. And they say, okay, here's how much we think we're going to be raising rates. And then if you compare that to what the bond market has said how much they're going to be raising rates, the bond market's been right on. I mean, actually really close to where we are right now was what was projected, whereas the Federal Reserve said they weren't going to be raising rates at all in 2022 last year. So that's where, you really want to follow the bond market yields. It's why we look at the 2-year Treasury yield so much, because that's the one that's the most sensitive to changes from the Federal Reserve. And so if you really want to have a good idea for where at least the bond market thinks things might go, it might give you some, a window into kind of understanding, where things can play out.
Yeah. So is there anything with the duration of this inversion? Because you can see in 2019 there was also an inversion, but we didn't really see a recession in 2019.
Yeah, there's a great white paper on the New York Fed website where they go back and really dig into this particular inversion. And there's a couple of surprising pieces. Number one is it's not the depth. It's not how much it's inverted. There's almost no correlation to how much it's. You can have virtually no inversion, but it's the duration. So it needs to be 3 months. So October 25th was when we inverted this year, and so 3 months from then is what, January 25th.
Yep.
If we're still inverted by then, I think it's a 94% chance of recession or something along those lines, based on the projections from this particular indicator. Now you can see, we're actually pretty far deep into it, which again doesn't matter except for the fact that it's going to be a little bit harder for it to get back to zero because of that depth, and that might drag it out through that 3-month period. So we're still in the wait and see mode here to see how this plays out. Yeah, that's good point. All right. What other questions do we have?
What is dollar cost average investing, and how often should I be adding money when I'm dollar cost averaging?
Dollar cost averaging. Okay, so that's basically, putting money in every month or every paycheck or, whatever the scenario is, versus just purchasing a lump sum. We did get this question before. We have a nice graphic that I think is worth looking at. This is from Franklin. It just shows, kind of how it works. So you take $1,200 and you buy, a lump sum, $10 a share. Or you buy $100 a month for 12 months. And so you can see, it's higher and lower, kind of a sideways motion really altogether, because it ends up at $10 a share at the end. So the lump sum in this scenario didn't make anything.
Yep.
But the average purchase price of the dollar cost averaging was $9.16.
Yep.
Right? So it worked out better in an environment where, you were dollar cost averaging. You're going to end up at the higher rate of return, at least over this time period, this 12-month period. And so it kind of takes away some of the guessing as to where the market's going to go, and just allows this kind of dollar cost averaging concept to happen. But it isn't the perfect solution for every market type. Where does it struggle?
Yeah. If you're thinking about, if you're trending upwards in an up market, if you had a lump sum and you were to buy at the beginning, it'd be a lot cheaper than if you were to average across that uptrend.
Yeah, if you went from $10 straight up to $12 over that 12-month period, and basically didn't have much variation, 2021 comes to mind. That was a year just like that. I think the biggest downturn was 5%, so it pretty much went straight up. And you're better off buying the lump sum, because now you've got $10 going to 12. You made $2 a share, and probably didn't make as much on the dollar cost averaging. Those markets are a little bit rare, and that's why the dollar cost averaging works, and it works even better on the straight down one.
Yeah.
Just because, again, you buy at 10, now it goes to 8. You've lost $2 a share, but if you bought on a dollar cost averaging basis, you've bought some of those closer to 8. So your average is below 10, which is better than the lump sum.
And you can see in the example, when you're buying at $8, it's saying you're getting 13 shares, but you're probably getting 12 and a half shares, but you're still getting 2.5 more shares for your money.
That's right. Yep, exactly right. So it's a great concept. It's how 401ks do so well. You get a match, hopefully, and you put money in. It just goes in over and over again, no matter where the market's going. And over the long period of time, it does tend to, historically lower the average cost per share purchased, as far as that goes. So I think it's a great strategy. I would say, though, most of the times you're dealing with this, it's not because somebody has the lump sum, like in this case, has the $1,200, and they're trying to decide between directions. Usually people just put that in, that $1,200. But you'll see more when they don't have it and they have the 100 a month. And so how does that work? So that's where the 401k comes in, for example.
Yeah, and so if you're looking to set up a dollar cost averaging, usually I say match it with your cash flows. So if you're getting paid every 2 weeks, just every time you get paid, buy some more shares, and that's a good way. If you're getting a lump sum and you're kind of worried about timing the market, maybe you take that and you split it over a duration. Say if you got $100,000 of cash for some sort of windfall, how would you break it apart? Maybe you divide by 12 and you just break it up and do it once a month.
Yeah, yeah, exactly. All right. What's some other questions that we had?
So I've been cleaning out my garage and selling stuff on eBay. This year I'm getting a 1099K based on the new rules that eBay, PayPal, Venmo have to report $600 of income into your account versus the previous threshold of $20,000. How is the earnings reported on the 1099K taxed?
Yeah, okay, so if you have $600 or more of income from selling, we've been selling my son's old golf clubs out of our garage, on eBay, for example. And so they're going to now report it. It used to be a $20,000 threshold, and we don't have that many golf clubs, although it seems like it. And so now we're having to deal with it on the tax return. It is classified as ordinary income.
Yep.
And so if you sell $10,000 worth of golf clubs in this case, that $10,000 goes on your tax return. Depending on what your tax bracket is, you could owe taxes on that. So might want to keep some of it aside, right, for those purposes. So you don't get surprised and owe $2,000 in tax, and then you've already spent the $10,000 you made or something like that. So.
Yeah, and this is a little bit harder. A lot of the time, people don't report, these small incomes because they're just so incidental. But now that PayPal and eBay and all these companies are reporting it, it goes automatically to the IRS, and so their computer system will automatically flag it, and so it's much harder. You shouldn't be not reporting this, essentially.
Yeah, before it's like, oh, I'm just getting this money for selling something I bought a while ago, and I don't really need to report it, but now the IRS knows. And so, and if you don't report it, the IRS knows you didn't report it. It's pretty basic. Of course, I've heard that the IRS is pretty far behind on some of their tax returns, but when they catch up, they'll be able to see that, that money, whatever, 10,000 in this case, that you didn't report is now, should be on your tax return. It's not. Probably end up with some penalties and interest also.
Yeah, and unfortunately, you can't use like capital gains rules or personal loss rules on these. Right. IRS doesn't consider personal loss because as part of your tax calculation. And so even though you say, I bought these golf clubs for $300, I used them for a bit, and now I'm selling them on eBay for $100. I lost $200 on these golf clubs. But IRS only sees the income. They don't see that loss, and they're not going to count your losses.
Which is really too bad.
Yeah.
Because most of the clubs we're selling, well, all the clubs we're selling are, for less than we purchase them for. You can make money on, things on appreciation basis. You can buy things and sell them for more, actually. But, yeah, they don't allow the write-off like you would with a stock. If you put $300 into a stock and got $100 back out, you'd have a $200, loss that you could use against gains. So. It's interesting.
The only way you could really do this, if you wanted to really do this, have a cost base and stuff like that, you'd have to register some sort of company, and you'd have to make it kind of like, this is my business. I have like an LLC or something like that, and we know how much it costs that we paid for it, but usually you're making profits when you do buying and selling stuff like that.
That's right. I would assume they're. For example, I have a Mini Cooper that's my project car, and I ordered a piece off of eBay, for example, that I needed to put in some speakers in the car that didn't come with my existing car, and so this is a company I ordered from in North Carolina, and they basically buy up used Minis and part them out. They just take the parts and put them on eBay. And I'm assuming they're making a profit. That's why they're there. But yeah, that would be a business. It's a little bit different than the average person selling their golf clubs. Yeah, it's a good question.
So why have real estate prices not come down as much with interest rates skyrocketing?
Yeah, Bloomberg had a really great article on this that really I thought was very well done. And they said that, the demand was so high, right? I mean, we saw crazy things with so many offers, 30 offers in an hour on a homes here in the valley, and that has now dissipated, right? But the prices are still holding up fairly well, considering that mortgage rates went from 3% all the way up to 7 at one point, in a really fast manner. And what has happened is that although demand has come down, it's still a little bit higher than the supply. And that's the big story here, is that there's not a lot of supply coming on. So you have new builders are all backing away from building because they're afraid of this environment. So that doesn't add supply to the overall nation's, supply of homes. You have interest rates on mortgages went from 3 to 6.5, 7 now. And so if you have a house and you have a mortgage and you want to move someplace else and still have a mortgage, you might be giving up that 3% mortgage to get that 6.5, 7% mortgage. So that keeps people even less so from wanting to move, right? And so they're just not getting a lot of motion within the market. In 2008, so many people had been sold homes that they couldn't afford that they got foreclosed on. A huge amount of supply came in, and that did have a much bigger impact on the price. So to see a big impact, we need to see more supply come in. And so it could happen, right? In a recession with a high number of job losses, you're going to get some people that can't afford their payment anymore if they can't get a new job right away, and they might be selling their houses, and that increases supply. So and probably brings down demand some too if less people have jobs. So that combination of kind of more supply and a lowered amount of demand, you'll start to see the price, drop, more aggressively in that situation. And so that's it's very fascinating. You see it like we're in a valley here. And one of the things that it's hard to bring on lots of new construction supply because there's not a lot of open land. They do kind of make some density. They'll tear down a warehouse and build some condos, or
they'll mix commercial.
Do
and
some of
real
that.
estate.
But if you go out to say Sacramento or Kansas, where my in-laws are from, the ground is super flat, it's wide open. You go for 15, 20 minutes. There's a giant field, and the contractors can start to build homes. And so that's why you don't see as much in the way of appreciation in some of those places, because there's more supply coming on. And so that's the key dynamic there, is just that the supply is not coming on yet. They did talk about in that article about, some people might be delaying their moves, and that they might not be able to continue to delay forever, job relocations and those types of things. Or even, one thing that's interesting here in the Valley, we're starting to see more and more requirements to come into work. And so if you move to Bend, Oregon, and you got to get to work in Mountain View, you might be selling your Bend, Oregon house if you want to keep that job, and maybe you'll get a different job. But, again, if you have to be there 4 days, I just saw, who was it? Snap just said that 80% is what they're looking at in February. They want you to be working out of their office spaces 80%. Of course, we've all know about the Twitter story. And so those could be things that could kind of drive supply too, is just people having to come back into the areas where they were, that they've left because they could work remotely someplace, less expensive. So, we'll see how that plays out. All right, well, that's another show, actually. So really looking forward to being able to help you out here. You can, of course, send in your questions anytime. We love answering these, especially if you send them in early. We can make a chart or find something fun. And so Ask Tom at talkmoneywithtom.com is a great place to send questions. And then, of course, feel free to subscribe to our channel. Increasing your education around the financial portion of retirement should be able to help you have a more successful retirement. And so you hit the subscribe button, hit the little bell if you want to get notified, and then you set up an appointment. If you have a personal question that you want Ethan and I to answer, go to our website, book an appointment, 30 minutes, video, phone call, and we'll discuss your situation specifically. So look forward to seeing you again next Friday, and thank you very much today for attending. Thank you.